The invisible anchor on your paycheck. Most people believe that taxes are calculated solely on how much money you make. The more you earn, the more you pay. But this simple understanding conceals a structural divide in the tax code, one that quietly penalizes the working professional while leaving the truly wealthy virtually untouched. The hidden tax that only the middle class pays is not a specific line item on a tax return. It is the tax on ordinary income, specifically W-2 wage income. When you trade your time for a salary, your money is taxed at the absolute highest rates possible before it ever reaches your bank account. Whether you are a teacher earning $50,000 or a surgeon earning $500,000, you are trapped in the same fundamental system. The ultra-rich, however, do not earn their money through wages. They live in an entirely different financial ecosystem where the rules of taxation are flipped upside down. To understand how they bypass this system, we must first look at the illusion of the high salary. The $100,000 delusion. There is a psychological trap in modern personal finance, the belief that reaching a six-figure salary is the ultimate milestone of financial security. In reality, crossing into higher income brackets often triggers a dramatic increase in your tax burden without a proportional increase in your actual wealth. This is the reality of progressive income tax brackets. As a W-2 earner, every raise you receive pushes a larger percentage of your next dollar into the hands of the government. Furthermore, high earners quickly lose access to standard tax deductions, child tax credits, and the ability to contribute directly to tax-advantaged accounts like a Roth IRA. This creates a scenario where the middle and upper middle classes experience a severe bottleneck. You are working harder, earning more, but your net purchasing power stagnant because of the high tax drag on your labor. The ultra-wealthy avoid this bottleneck entirely because they have decoupled their income from their time. The asset velocity secret. If the middle class earns money through labor, the ultra-wealthy earn money through assets. This distinction is the foundation of modern wealth preservation. When you own shares in a company, real estate, or intellectual property, that asset can grow in value by millions of dollars in a single year. Yet, under current tax laws, that growth is completely untaxed. This is known as unrealized appreciation. According to the tax code, a tax event only occurs when an asset is sold. If a billionaire's stock portfolio increases in value from $1 billion to $2 billion, they owe $0 in taxes on that $1 billion gain, as long as they do not sell the shares. But this raises an obvious question. If their wealth is tied up in assets that they cannot sell without triggering a massive tax bill, how do they fund their lifestyle, purchase mansions, and acquire more assets? The answer lies in a financial strategy that turns debt into a tax shelter. Buy, borrow, die. The ultra-rich playbook. The strategy utilized by the wealthiest families to bypass income tax entirely is colloquially known as buy, borrow, die. It relies on three distinct steps that are perfectly legal under federal tax laws. First, they buy appreciating assets, such as stocks or real estate. Second, instead of selling those assets to access cash, they borrow against them. A bank will gladly lend millions of dollars at exceptionally low interest rates, using a multi-million-dollar stock portfolio as collateral. This transaction is the key. Borrowed money is not considered income by the IRS, therefore the loan proceeds are completely tax-free. The borrower uses this untaxed cash to live on or to buy even more assets. Finally, when the individual passes away, their heirs receive the assets with what is called a, quote, stepped-up basis. This resets the taxable value of the assets to their current market price, wiping out decades of capital gains taxes. The cycle then begins again with the next generation. Why your savings account is a tax trap. While the wealthy use debt to grow their wealth tax-free, the middle class is often encouraged to do the exact opposite, save cash in a traditional bank account. Unfortunately, this standard financial advice functions as a quiet wealth destroyer due to a combination of inflation and taxation. If you hold cash in a high-yield savings account earning 4% interest, you might feel like your money is working for you. However, that interest is categorized as ordinary income. It is taxed at your highest marginal bracket. After federal taxes, state taxes, and inflation are accounted for, your real rate of return is often negative. You are effectively paying a penalty for holding cash, while the interest you do receive is taxed heavily. This is another facet of the hidden tax structure. The system encourages asset ownership and penalizes cash preservation, yet most traditional financial advice focuses heavily on the latter. The phantom capital gains illusion. Even when middle-class investors attempt to participate in the stock market or buy real estate, they often fall victim to the phantom capital gains tax. This occurs when you hold an asset for several years, sell it for a profit, and pay taxes on gains that were actually driven entirely by inflation. For example, if you buy a property for $200,000 and sell it 10 years later for $300,000, you have a nominal gain of $100,000. You will be taxed on that full amount. However, if inflation has reduced the purchasing power of the dollar over those 10 years, your real gain may be close to zero. The tax code does not adjust your cost basis for inflation. You are forced to pay real tax dollars on imaginary profits. The ultra-wealthy bypass this issue because they rarely sell their primary assets, avoiding the realization of these phantom gains altogether. Stepping over the tax line legally. Understanding this system is not about complaining. It is about recognizing how the rules are structured, so you can adjust your financial strategy. The U.S. tax code is not just a list of restrictions. It is a system of incentives. The government uses tax breaks to encourage individuals to invest in things the country needs, such as housing, energy production, and business development. The ultra-wealthy align their investments with these government incentives. By investing heavily in real estate, they gain access to depreciation write-offs that can offset their other income. By investing in businesses, they can utilize corporate structures to deduct legitimate expenses before taxes are calculated. W-2 employees do not have these options because their taxes are deducted automatically at the source. To escape the ordinary income trap, one must transition from being a pure wage earner to an asset allocator. The transition moving from labor to capital. To protect your wealth from the hidden tax on the middle class, you must consciously shift your financial focus from maximizing your salary to acquiring assets that generate capital gains or offer tax advantages. This transition begins by utilizing tax-advantaged accounts to their absolute limits. Maximizing a health savings account, a 401k, or utilizing backdoor Roth conversion strategies are the first steps in shielding your money from immediate income tax. Beyond retirement accounts, the focus must shift to building a portfolio of equities, real estate, or private business interests. The goal is to gradually replace your highly taxed active income with lower taxed passive income and capital appreciation. By changing how you earn, you change how you are taxed, allowing you to finally step out of the middle-class tax trap and build enduring wealth.